Sending extra payment to your existing mortgage or using a HELOC to pay off your mortgage, which one is better? Now, it is true that both method can help you save money and time, but which one is better in terms of the outcome, the results, and the benefit? So here in this video, we're gonna do a direct numbers to numbers comparison of sending extra payments to the existing mortgage as a way of saving money versus using a HELOC to pay off your mortgage faster, aka the accelerated payoff method. Now, before we dive in to start comparing the two methods, I do want to set the disclaimer up saying that the illustration that I'm sharing with you is for educational purposes only, and the scenarios that I'm painting is to show you the concepts behind how each methods can help you save money, and depending on your situation, the accelerated payoff might be better, or just simply paying extra into the existing mortgage might yield better results. So with that disclaimer out of the way, let's go and set things up and give you the parameter and the context as to what we're doing. So on the left is a free calculator that I found through calculator.net. Feel free to check them out. I think they provide and create great calculators for financial concepts. And I am using their free mortgage payoff calculator, which I have the option to factor in extra payments to the mortgage or simply to make bi-weekly repayments. On the right is our free accelerated payoff calculator, which you can download for free. It's in the video description down below. You can opt in to get the free version of our calculator. And with that link in the description below, you can opt in to download this very same calculator that I'll be using to compare extra payment versus using accelerated payoff. So with that said, here are the parameters, and you can see the numbers on both calculators. We're working with a $300,000 original loan amount. Okay, I got that same exact number here. Current balance at $300,000, 5% interest rate, 30-year term. So we're establishing the fact that both have the exact same mortgage numbers. All right. Now, with the accelerated payoff calculator, the cash flow matters a lot, right? The accelerated payoff strategy is a cash flow strategy. So to make this as realistic as possible, we're working with the $7,000 post-tax income with the $6,500 monthly expenses, including all the debt payments. And that includes the mortgage payment. So essentially we have a $500 of free cash flow savings each month that we're working with. On the left side, on the calculator.net, which will represent the extra payment way, we got the same amount in there as well, $500 per month that we're making an extra payment to the existing mortgage. So to begin our comparison, let's go and start out with the bi-weekly payment version. Now, this is a strategy for helping to pay off your debt faster. Yes, it does help save money and time compared to the original payoff schedule. And for those that are not familiar with the bi-weekly mortgage payment strategy, we're essentially taking our normal monthly payment, dividing it by half, and we're making those half mortgage payments every other week, so hence bi-weekly. And this works really well where whenever you get paid, bi-weekly or the 1st or the 15th, as far as your paycheck goes, you simply take a small chunk out of that to make your half mortgage payment. And so by doing that, you end up with 26 total payments in a year, which is actually 13 full monthly payments. So essentially you're making 1 month of an extra payment in a given month to help reduce the principal balance. So let's go and start out with the bi-weekly payment to our mortgage and compare the savings. So on the bi-weekly side, which is on the left side of the screen, we're looking at a payoff in 25 years, 4 months, okay? And this will result in a saving of about $50,054. So you can see that right here. All right, so we will pay off our 30-year mortgage in about 4 years and 8 months earlier, saving us approximately $50,054 in interest. So making bi-weekly payments will certainly help you save time and money compared to the original 30-year plan. Now let's go look at what the accelerated payoff version looks like. All right, so with the accelerated payoff, we're gonna pay off our mortgage in approximately 17 years and 6 months, okay? Total interest of $153, and with the savings for the interest, we would save about $126,438 for our accelerated payoff concept. So you can see almost double that of your interest savings potential when compared to the bi-weekly payment. So clearly the winner in terms of both interest savings and time savings when we compare bi-weekly payments and accelerated payoff will win given the parameters we're working with. So there we go, $126,000. Expect to pay this off by April of 2043. And with the bi-weekly payments, I don't think we have a clear date as to when. And this is assuming starting today, so it may change. So that's our bi-weekly payments versus accelerated payoff comparison. Now, what if we decided to take $500, which is our free cash flow for both scenarios? Again, our income on the accelerated payoff side is $7,000, monthly expenses $6,500, including all of our cash outlay, debt payments, so forth. So on the extra payment side, if we took that $500 and just simply make extra payments at the end of each month, what could the results look like? So let's go and compare that. All right, I'm gonna hit calculate on the left. There we go. And so what the mortgage payoff calculator with the extra payment, without the HELOC, without accelerated payoff, we're gonna pay off our mortgage in about 18 years. Okay, so 12 years earlier, saving about $124,383 in interest. So pretty good. Those are some serious savings, and it's definitely yielding really great results. So now let's go look at accelerated payoff. Again, same result basically as the biweekly. Again, exactly the same result when we compare it to the biweekly scenario. So 17 years, 6 months, okay, our interest saving is $126,438. So what's interesting is that, again, they're very close, but yet the accelerated payoff concept is the winner by about $2,000-ish, right? So we'll get to save estimated about $2,000 more with the accelerated payoff concept, right? Using a HELOC to pay off our mortgage faster. And we have about 6 months of additional savings on the accelerated payoff side compared to the extra payment calculation that we just did. Again, calculator.net. We don't own that site. It's an independent site that is operated by a separate company. And so with the accelerated payoff, it does seem to yield a better result given the parameters that we put in for the calculator. Now, I do want to let you know, okay, for transparency, that the assumption we're making on the accelerated payoff is that we're using a chunk size of $10,000 on the HELOC at 6% interest rate for the HELOC. Now, that also brings up a very interesting thought because the HELOC is at 6%, our original mortgage is at 5%. And so even by using a 6% interest rate HELOC, $10,000 principal chunk at a time, we're still able to save a little bit more money, right? It's not a huge or large amount. We're still able to come out ahead when compared to just doing extra payment. Now, a feature that exists on the accelerated payoff side, the right side, that you won't get on the just simply making extra payments to the mortgage is that with the HELOC, it gives you access to your equity, okay? In case of an emergency or you find yourself with an investment opportunity, the HELOC does give you access to liquidity because it's a revolving loan, meaning you can borrow from the HELOC whenever you need to, pay it back, borrow from again, and over and over and over again. Whereas with the mortgage, as soon as you make that extra payment, right, unless you do a cash out refinance, there's no real meaningful way to get money back out, right? So the HELOC gives you maximum flexibility in case of an emergency. You know, I've seen it with government shutdowns where I see individuals get furloughed without income. The HELOC does come in handy for those times where there's a lot of uncertainties, curveballs are being thrown at you. It just gives you more flexibility. And I feel like with the modern times and all the uncertainties that we're dealing with, the market, the economy, tariffs, right, government shutdown, we need to have some level of safety net and liquidity and options. And I just don't believe that the extra payment will give you that unless you do cash out refinance. But then by the time you do that, that might take a couple of weeks. So the HELOC does give you more flexibility. Now, I just showed you a scenario where the accelerated payoff does yield a better result. Are there instances where just simply making extra payments to the mortgage makes better sense? Yes, there is. Okay, I'm not here to say that the accelerated payoff is automatically the end all be all. It is triumphant in all cases. I'm not saying that. Okay, I have seen in many cases where the simply making extra payment to the mortgage just makes more sense. Although you'll lose the flexibility, the liquidity, right, to be able to draw money out when you need to. But I have seen scenarios where making extra payment to the existing mortgage just makes more sense that way. So the whole point as to why I want to show you this and do some comparison is to shatter some myth that just because the HELOC is at a higher rate doesn't necessarily mean that you'll end up paying more. There are instances where you'll come out ahead even though the HELOC rate might be slightly higher than the mortgage. The second point that I wanted to show you is that just because the cash flow is exactly the same, where on the accelerated payoff, we had the same exact $500 cash flow, right? We didn't add more money to it. And on the extra payment side, we also had the same exact $500 of cash flow. Just because you had the exact same amount left over, it doesn't necessarily translate to the exact same result. And you might be wondering, well, why is that? Why do we see better savings with the HELOC, though the interest rate's higher, though they are both debt, and they both use simple interest calculation? What makes the HELOC special and different in the sense that it yields better results? So if you're curious as to why that is, and why does the HELOC act differently than a mortgage interest calculation, here's a part 2 video that I'm gonna put it on the screen. Click on that and I'll explain to you why the HELOC interest calculation is different than the mortgage calculation, and the difference, we can use it towards our advantage and save money and time. So with that said, if you enjoyed this video, leave your thoughts and comments down below, and let's go to part 2. Click on that video right now and we'll see you there right now.